All right, today we're diving into a company that's about to go public, Patel Retail. They're a regional supermarket player, but they've got some pretty big ambitions. So let's break down their upcoming IPO. So, another retail stock is getting ready to hit the market. And that brings up the question we always have to ask ourselves as investors. Is this a golden opportunity, or is it a risk you should probably steer clear of? And that's what this explainer is all about. We're going to look at the good, the bad, the opportunity, and the risks to give you a really clear picture of the Patel Retail IPO. Okay, let's get into it. So first things first, let's get to know the company itself and the really big bet that they're making on their future. So who is Patel Retail? Well, at its heart, it's a supermarket chain with 43 stores. But they have a very specific game plan. They're focused on the Thane and Raigad districts in Maharashtra, targeting smaller cities and suburbs that are often overlooked. But here's the kicker, the thing that makes them different. They have an integrated business. They don't just sell stuff, they actually make their own products. And that is absolutely key to their whole strategy. Okay, so let's start with the optimistic view. What are the strengths that have some investors getting excited about this IPO? Let's unpack the bull case. The entire bull case, really, it all boils down to one massive strategic shift. Patel Retail is deliberately walking away from a business that makes a ton of revenue, but almost no profit. That's commodity trading, and they're diving headfirst into what really matters, high-margin retail. And you can see that pivot right here on this chart. I mean, just look at the change in only 2 years. Back in fiscal 2023, retail was just a quarter of their business. By fiscal 2025, it's projected to be nearly half. This is no accident, folks. This is a radical, deliberate reshaping of their entire company. So how are they actually pulling this off? Well, it comes down to 3 key moves. First, that integrated supply chain means they control everything from making their own brands, like Indian Chaska, to putting them on the shelf. Second, they're going all in on those private labels. Why? Better margins, and it keeps customers coming back. And third, they're expanding smartly, using a cluster approach to really dominate specific local areas. The strategy sounds pretty solid, right? But do the numbers actually back it up? Well, it's time for a reality check. And this is where the story gets interesting. Okay, take a look at their core financials, and you'll spot something kind of weird right away. Their profit is up a lot, and the profit margin has almost doubled. That's fantastic. But look at the top line. Their total revenue is actually down. Wait, what? How on earth does that happen? This is the puzzle right at the heart of Patel Retail's financials. You've got a 54% jump in profit happening at the exact same time as a 19% drop in revenue. So is this a sign of a company getting stronger or weaker? And here's the explanation. That drop in revenue wasn't an accident. It was a choice. The company deliberately got rid of a huge, low-margin bulk sugar trading business. They basically sacrificed low-quality revenue so they could focus on generating higher-quality, much more profitable earnings from their actual stores. Now, the rest of the balance sheet kind of tells a similar good but story. The return on equity is over 19%, which is pretty respectable. It basically means they're good at turning investor money into profit. But then you get to the debt. A debt-to-equity ratio of 1.34, let's call it moderate. It's better than it was, for sure, but it's not insignificant and definitely something to keep an eye on. Okay, we've seen the bright side, but every single investment has risks, and Patel Retail is absolutely no exception. So let's flip the coin and look at the bear case, the red flags that the prospectus reveals. I want you to just look at this number for a second. 34 crore rupees. It's a big number, but what does it actually represent? That is the amount of money owed by customers that is more than 6 months late. We're talking seriously overdue bills. This is a huge red flag. It raises real questions about their cash flow and whether they can actually collect on the sales they're claiming. And the concerns don't stop there. Their inventory is moving much, much slower. The time it takes to sell products has more than doubled. That's cash just sitting on shelves. A 12% profit growth sounds fine, but for a company starting from such a small base, it's actually kind of sluggish. And finally, with all 43 stores in one state, they're completely exposed to any economic problems in that one specific region. Now, to put all this into perspective, you have to compare them to the elephant in the room, D-Mart. What's wild is that their operating margins are surprisingly close. That's a good sign for Patel. But that's where the good news ends. D-Mart's revenue is growing at over 18%, while Patel's is almost flat. And look at the debt. Dmart is nearly debt-free, while Patel's is carrying quite a bit more. This just shows you the intense pressure they are really under. So we've seen the strengths of their strategic plan and the very real risks sitting on their balance sheet. How does this all come together for you as a potential investor? You know, this quote really sums it up perfectly. You're looking at a company with a clear plan to get more profitable, but that plan comes with significant baggage, those overdue payments, and a notable amount of debt. It is a classic high-risk potential reward scenario. So let's boil it all down. Here are your key takeaways. The bet you're making is on their strategic shift to high-margin retail. The hope is that they can actually execute this plan, expand successfully, and clean up their operations. But the risk is that they fail, get crushed by competitors like Dmart, and can't solve those nagging balance sheet problems. Ultimately, it all comes down to a simple trade-off. Are you willing to take on these very clear and present risks for a shot at their long-term growth story? It's a question of growth versus risk, and only you can decide which side you're on.